Is America heading towards a recession? The Dow recently plunged more than 1,000 points, and Japan's Nikkei experienced its worst day since 1987, dropping 12%. These alarming events suggest that a recession cannot be ruled out just yet. For the first time since 2020, we are witnessing a perfect storm, causing some of the largest single-day losses since the COVID-19 pandemic. Let's dive into what's happening, why the stock market has fallen so much, what this means for you, and what history tells us might happen next. For the first time since 2020, a convergence of events has led to massive single-day losses in the stock market. The global interconnectedness of economies means that what happens in one country can have ripple effects worldwide. This time, it starts with the Japanese yen unwinding. Global economies are tightly interconnected. For instance, the decisions made by China can significantly impact the U.S. economy. Despite the U.S. dollar losing some purchasing power over the years, it remains the world's reserve currency, which creates a consistent demand for U.S. treasuries. Every country has its unique currency, interest rate, and inflation rate measured against the U.S. dollar. This discrepancy creates arbitrage opportunities where traders borrow in one currency at a low interest rate and invest in another currency with a higher interest rate to profit from the difference. Japan's financial system, plagued by decades of deflation, an aging population, and weak demand, has kept interest rates at historic lows to incentivize spending, borrowing, and trade. Recently, the U.S. raised interest rates at the fastest pace ever to combat record-high inflation from 2022 to 2023. This made U.S. Treasuries highly attractive, presenting traders with an opportunity to borrow yen at low rates, convert to U.S. dollars, and invest in high-interest U.S. Treasuries. Additionally, the yen has historically depreciated relative to the U.S. dollar, meaning traders could repay their loans with fewer dollars than they borrowed, pocketing extra profit. However, Japan recently raised its interest rates to curb the declining value of the yen. This caused the yen to strengthen and the U.S. dollar to decline. For traders who borrowed in yen to invest in U.S. Treasuries, this shift means they now need more dollars to repay their loans, leading to significant losses and triggering a massive sell-off in the stock market. On July 10th, one U.S. dollar could buy 161 yen, but after the rate hike, it only buys 143 yen, a more than 10% decline. Spread across trillions of dollars, this change creates a financial storm. Japan saw its biggest one-day loss since Black Monday of 1987. The decision to raise interest rates was driven by the need to combat inflation. A declining yen makes imports more expensive, forcing Japan to act to stabilize their currency. Compounding the issue are rising recession fears in the U.S. Recent reports indicate that U.S. companies are not hiring at the expected rate, with unemployment rising to 4.3%. Historically, a rising unemployment rate can be an indicator of an impending recession. Since the 1950s, if the unemployment rate's 3-month moving average rises by half a percentage point from the previous year, a recession is likely imminent or already underway. The S&P 500 is currently back to where it was 3 months ago, down less than 10% from the peak, which is not uncommon. Market drops of 10% happen about every 16 months on average. However, it's too early to tell if this is a short-term hiccup or a signal of deeper issues. Despite the recent market volatility, it's important to stay prepared. Keep a 3 to 6 month emergency fund to avoid selling stocks during income reductions. Spread investments across cash, treasuries, index funds, real estate, and cryptocurrencies. Continue buying and holding regularly, regardless of market conditions. Resist the urge to sell during downturns to avoid emotional decisions. Ensure a stable income to continue investing without needing to sell assets. Keep extra cash for peace of mind, even if it's not the most optimal for returns. Ultimately, time will tell how this plays out. While stock market drops can be unsettling, there are also opportunities for significant future gains.